All right, let's dive right into this explainer. If you thought Nvidia's momentum was starting to cool off, well, their August 2026 Q2 earnings report just completely shifted the landscape again. If you follow tech and finance, you already know they've been the undisputed heavyweight champ of this whole AI boom. But today, we're going to pop the hood, look closely at these new numbers, decode exactly what management is signaling, and figure out what's really happening beneath the surface of this behemoth. I mean, just wrap your head around this number. $96.2 billion in quarterly revenue. To put that into perspective, that is literally over $1 billion a day. Wall Street was basically bracing for something around $92 billion. So Nvidia didn't just scrape past expectations, they absolutely crushed them by over $4 billion in a single quarter. It's just a staggering amount of capital flowing through their ecosystem right now. But honestly, the real jaw-dropper here isn't just that massive revenue beat. It's their long-term guidance. For the first time ever, management laid out a long-term forecast, and they are projecting a massive 70% revenue growth for fiscal year 2028. Why is that such a big deal? Because the street's guess was sitting way down at 45%. You don't just throw out a 70% growth projection lightly. They're telling us they have crystal clear visibility into sustained, massive demand that the broader market just hasn't fully priced in yet. So, here's our quick cheat sheet for today's explainer. First, we'll hit those blockbuster earnings. Second, we'll build the bull case. Third, we'll flip it over to look at the bear case and the risks. And finally, we'll wrap up with our key takeaways.
Starting right off with part one, blockbuster earnings.
The entire engine behind this massive beat was the data center division. Data center revenue alone hit an astonishing $89 billion. That's a 117% jump year over year. I mean, think about that. More than doubling a segment of that size in just 12 months. Naturally, the market loved it, sending the stock surging over 7% intraday to land around 225. The initial shockwave was undeniably positive. But is this actually a market peak, or is it a golden buying opportunity? Let's jump into part two, the bull case. For the optimists, it really all boils down to valuation. Despite being this absolute titan of a company, Nvidia trades at just 24 times forward earnings. Now, stack that right up against AMD, which is sitting at 32 times. You're essentially snagging the undisputed market leader for a cheaper forward multiple than its main rival. And it gets even better if you factor in their insane growth rate. That brings us to the PEG ratio, which is sitting at a tiny 0.59. Now, in the investing world, the PEG ratio, which compares price to earnings against growth, is a fantastic benchmark, right? Anything under 1.0 is generally considered a strong value. So at 0.59, the bulls are screaming that this is a deeply undervalued asset compared to how fast it's expanding. If you're wondering where all that growth is actually coming from, just listen to CEO Jensen Huang. He flat out said on the call that demand is, quote, far above 70%, and the only constraint is supply. That's absolutely crucial to understand. Nvidia does not have a demand problem. They have way more eager buyers than they know what to do with. It's a capacity constraint. They literally cannot churn out these chips fast enough to feed the market. And the hard data totally backs that up with massive enterprise commitments. Case in point, AWS just locked in an order for an additional 2 million Nvidia GPUs, stretching all the way out to 2029. In the tech world, 2029 is basically a lifetime away. This isn't some short-term hype pop. This is structural, multi-year customer lock-in that most hardware companies can literally only dream of. Looking at how this plays out moving forward, we've got our record Q2 baseline today. But the next massive catalyst is already staring us in the face. The new Rubin architecture. This upcoming chip cycle is expected to add roughly 250,000 units in the very next quarter alone. And, as any seasoned hardware investor will tell you, new product cycles predictably ignite massive new waves of revenue, which perfectly bridges the gap to that huge 70% growth projection for 2028. Rounding out the bull case, we got to talk profitability. Gross margins are sitting at an exceptionally healthy 74%. For a hardware company, that is just wild, and it really flexes their pricing power. Because of this perfect storm, high margins, crazy growth, relative value, Wall Street analysts are seeing massive upside. The consensus price target points to a 46% jump, around 306. And the mega bulls, like Milius Research, they're aiming as high as 420. The thesis is simple. You're getting a hyper-growth AI leader at a value multiple. All right, let's flip the coin and play devil's advocate for a minute. Part 3, the bear case and risks. Let's revisit that valuation argument. The bulls love that 24 times forward PE, right? But the bears see a catch. If you strip out the one-time gains and look at a normalized PE ratio, it's a totally different story. Normalized, it's closer to 60 times. Suddenly, it doesn't look like quite such a steal. And honestly, this debate perfectly explains why the stock has been essentially waterlogged, just stuck trading flat in this frustrating range between 190 and 230 for months, even with blockbuster numbers. Then, look at their customer base. A staggering 54% of their revenue is tied up in just 3 hyperscaler clients. That's a huge operational vulnerability. Talk about putting all your eggs in one basket. If even one of those tech giants decides to dial back their infrastructure spend, even for a little bit, it would hit Nvidia's bottom line incredibly hard. Plus, there's a gaping geographic blind spot, zero. Because of geopolitical constraints, Nvidia's exposure to the massive Chinese AI GPU market is effectively zero. They just don't have a compliant product on the horizon to serve that region right now. It completely walls off a massive, super lucrative demographic, essentially putting a hard ceiling on their global growth. So structurally, the bears are pointing to 3 major execution hurdles. First, margin pressure. Rising memory and wafer costs threaten to squeeze those stellar 74% margins down to maybe 71 or 72% as early as next quarter. Second, execution risk. Hitting that 70% growth means the Rubin rollout has to be flawless. And third, that hyperscaler reliance. Any pullback in spending is going to trigger a painful downward re-rating of the stock. Basically, the bull case is awesome, but it requires absolutely perfect execution. Okay, let's bring it all home. Part 4, key takeaways. Here's what you really need to walk away with. 1. Nvidia's scale and customer lock-in are completely unmatched. They are the undisputed leader in AI infrastructure. 2. That unprecedented 70% long-term guidance tells us management sees massive sustained spending. This looks like a long-term secular trend, not just a fleeting bubble. But 3, and this is absolutely crucial for managing your risk, you have to obsessively watch this upcoming Rubin rollout and margin stability. If margins hold the line at 71% and Rubin launches perfectly, the stock probably breaks out. But if costs spike or the launch stumbles, the downside is very real. So, I want to leave you with this final thought to chew on as you evaluate the tech space going forward. When you look at the sheer mountain of capital being deployed and the heavy reliance on just a handful of hyperscalers, ask yourself, is this the dizzying peak of an AI bubble just waiting to pop? Or is it simply the dawn of a massive secular trend that's going to rewrite our economy for decades? Thanks for diving into the numbers with me today, and definitely keep your eyes glued to those margin reports next quarter.